Thursday, 17th of August. Hope everyone is well. Just going straight into the charts this morning. We're pretty flat overall in the stock futures. We've had a marginal uptick since the cash open in the futures market. The S&P just back above pivot. Likewise in the DAX and Euro stocks. In terms of let's start with the close on Wall Street, and then we'll look at the FOMC minutes, of course, which came out last night. The actual close last night was, again, pretty flat. 0.1 in the S&P, the Dow, the Nasdaq up about 0.2%. But one thing obviously you can see on your charts is fixed income trading higher for last night. Certainly Bund still up about 10 ticks. We'll talk about those ECB sources again that we had yesterday in combination with obviously the minutes, which were overall dovish, has helped lift those prices. But gold up about $11 as well. We've had a little test of the late, or I should say early Asia Pac session highs up at around this 12.95 level, but we're sitting around R1 there. And then the dollar is pretty flat at the moment, but it's still trading lower post the move that was seen yesterday on the minutes, of which the dollar dipped, and consequently you can see here, top left, both major pairs moved higher. In terms of euro dollar, this was that move, really moved from around 117.26 all the way up through to test then the 118 handle, of which was then broken during the Asia Pacific session before seeing just a bit of a pullback here more recently. Cable, similar, it's kind of driven by the dollar weakness rather than sterling strength, and again just briefly did break the high of the prior morning before we've just found a bit of support around pivot for this last move back above 129. So what was the deal with the minutes? Obviously we've just said that they were dovish, and you can see that really reflected in the way that the market reacted last night, and to a certain degree how it's performed so far this morning. So the headline take was that most participants expected, and remember, it was inflation that was really critical, really two factors: the balance sheet tightening, when is that going to occur, and inflation, because inflation has been decreasing, or at least not being exactly where the Fed would feel more comfortable, i.e. back towards target, for them to kind of execute their more hawkish intentions. So the minutes said that most participants expected inflation to pick up over the next couple of years and to stabilise around the 2% objective over the medium term. However, many participants saw some likelihood that inflation might remain below 2% for longer than they currently expected, and several indicated that the risks to the inflation outlook could be tilted to the downside. So obviously this is a slight change in wording, a little bit more to reflect added concerns, you could say, on the inflation situation, and that's predominantly the reason why the market jumped on this in a more dovish interpretation overall. And so yields declined, T-notes rallied, the dollar fell, so both major pairs took a bit of a boost. And for the equity market, generally this type of situation is seen as a net positive for US equities, i.e. a slower rate of tightening or policy normalization, generally speaking, has been acting as a positive thing or development for US equities. On the balance sheet side, so on the balance sheet unwind topic, several members favoured an announcement in July meeting, but most preferred to defer the decision to the next meeting in September. So that September meeting obviously will be when we'll get the latest summary of economic projections. We also have the press conference with Janet Yellen, so it makes sense that they've bought themselves a little bit of additional time to just see how the economy plays out, especially this inflation issue, and then we are, as a broader market consensus, expecting that discussion to definitely occur at the next meeting in September. As far as the Fed are concerned, that then followed with a rate hike in December being their current plan. One thing is, though, although equities did see a slight lift on the back of the dovishness of the Fed minutes, what actually happened was Equities pulled back again slightly to close, as I said, basically flat. And that was because Mr. Trump's high-level business advisory groups have fallen apart after chief executive walked away in protest against the president's failure to clearly denounce that white supremacist violence in Charlottesville over the weekend. So essentially, they're not happy with the way the president has dealt with the situation. They've walked away. Trump's kind of tried to jump in and take back control of the situation and say, well, I didn't want the group anyway. I guess this is just kind of Trump style. But what does this mean? Well, yes, equities gave up a tiny bit of the gain that was seen on the minutes, but overall the reaction has been fairly muted, I would say. And obviously the one thing this does create is that the whole purpose of having a council of leaders of industry is that when you're talking about things such as a big change to tax, for example, obviously these are the types of people that you want to be speaking to. These are the kind of leaders of industry, and these are companies of which are very large and employ a lot of people, and by default then, in terms of tax revenues for the government and so on and so forth, these are the direct people that you want to be working closely with. Not exactly the time you would think to be disbanding it and saying, well, do you know what, I'm going to cancel these groups anyway, I don't need you guys. Goes back to the point yesterday, really. I think the market has largely moved on from what Trump is like, and although obviously his behavior can create the potential for huge disruption to the market, the reality is at this point, I think it's whenever he does do something like this, it's kind of to be expected to some degree, and therefore it fits within market expectations and does not have much of an underlying impact. So that was yesterday, that was last night. On the Korean front, there's been another slight development from overnight, which again lends its hand to being more positive to de-escalating the situation to some degree. This is because South Korean President Moon has said Donald Trump has agreed to ask for consent before taking any action, such as military strikes on North Korea. So basically, Trump has agreed with the South Korean president that he'll look to ask Moon, then only when the South Korean president has given it the go-ahead would then the US look to act. And you would think that logic would be that South Korean president would be highly unlikely that they would ever give the go-ahead, given that they are the ones that would likelihood be the first target of a North Korean attack. So again, you could say that this is an improvement of the situation from where we were last week. And obviously, if we're looking at equity markets, just bring up the S&P here and put it into context of where we were on the height of the tensions. You know, we were at record highs before really fire and fury and following comments came out from Trump. And obviously we had that biggest, on the 10th last Thursday, we had the biggest volatility day that we've had in a long, long time. However, if you're looking about a retracement, it's basically 2/3 of that move is already done. And so certainly the Korean situation has been largely taken back, still to be monitored. I think we talked about this on Monday. There are scheduled military exercises between the US and South Korea due to happen. I think it kicks off on the 21st of August and lasts for a period of 10 days. So certainly there is still scope for this issue to come back to the fore, but for the moment it's kind of taken a bit of a back seat, and so hence the market can react to things like the minutes rather than the geopolitics, which is such a dominant theme from last week. Other news to be aware of: Brexit. This is Sky sources very early this morning, and they were basically saying that the next phase of Brexit talks likely delayed to December. Now, the initial timeline was October, which was then going to be the next kind of high-level meetings. Phase 1, they call it, of the negotiations, so money, citizens, the border with Ireland, Northern Ireland, and so on, was all going to be discussed in October. However, inside, people on the inside have suggested, unnamed, of course, that this is likely to be delayed till December. This is because you've got the German federal elections happening in September, and essentially there will be a slight potential change likely in regards to the composition of the coalition government in Germany, and the UK feeling that actually they might be better positioned to talk to the newly formed Angela Merkel coalition with the Liberal Free Democrats rather than the SPD involvement, which obviously has the ex-European Parliament chief Martin Schulz as their leader. I can see why that might make some sense, but obviously come December, we start going into 2018, obviously the clock is ticking. We've already triggered Article 50, and really we've made very little progress thus far. And if you think about any type of more thorough agreement, it would of course have to have authorization across all of the national governments within the Eurozone. They would all have to sign off on any deal with the UK, which they've already stated right at the beginning of the process that that would take anything from 3 to 6 months. So you're talking about less than a year, if not 6 months, to negotiate Brexit. And really this doesn't come as much as a surprise. That's why I think hence cable is still fairly comfortable up at about 129 in the currency market, because this was always inevitable. There was no way that Brexit was ever going to be negotiated in the period of 2 years. That's specifically why the Lisbon Treaty was designed with Article 50 in such a way that no one in their right mind would trigger Article 50 in terms of exiting the EU. The clause was written to be such a short period of time, knowing that you wouldn't be able to achieve that objective. So the deal here is not about a full Brexit deal. It's about securing a transitional agreement and then thereafter talking about these ongoing trade talks and the kind of legality around that. And obviously, as I've said many times before, this process then likely to carry on for multiple years before we know the full outcome of what Brexit really looks like. So really it comes down to not really much progress going on here. I'm just trying to think of other events. Obviously before December, you've got the German federal elections, but you've also, which could be quite interesting, you've got the Conservative Party conference. That happens usually on the 4th, 5th of October every year, and could be just quite interesting to see how Theresa May fares amongst her own party when they're all there gathered in their entirety as a political party, just given the various pressures that she's had, the divisions that we've seen apparent according to various press articles within the Tories at the moment. That could also be something quite interesting. Any disruption on that side obviously would only further delay the process of these negotiations, you would imagine. And the tighter this gets, as the timeline goes on, we will, as Britain, inevitably have to accept some kind of concession, likely on our side, that being probably a fairly lofty bill to settle this divorce settlement with Europe before then they'll accept the transitional agreement, would probably be the likely scenario. But for the here and now, looking at the charts, cable finding a bit of support here this morning after a late decline in the Asian session around pivot, and the context being here that the pound's seen a pretty decent move this week thus far. It's been actually quite a big data week for the pound. If you think about it, you had the UK inflation reading back on Tuesday. The pound dipped broke some significant technical levels on slightly longer dated nature as well. That inflation reading 2.6 below the expected 2.7. So again, it kind of delays this need for any imminent rate hike and certainly lessens the hand of the Bank of England hawks, Saunders and McCafferty. You've then had yesterday, so it's kind of, if I just highlight the phases here that we've had, that's the kind of CPI move. Yesterday we had a brief rally, because if you're thinking about it from a Bank of England point of view, it's been quite a good week. You've had inflation not going higher, and you've had wage growth exceeding expectations. So if anything, there was this pattern of divergence materializing, and at least on this 1 month's reading, they've actually drawn a little closer. So they've converged this time round, which is much more going to please the majority of the MPC for sure. Unemployment rate, I don't think it was much of a surprise. It's been this case for a long time, the lowest since the kind of mid-1970s, but good wage growth certainly is something which is very much needed for the UK consumer, given even headlines overnight from Nielsen that people's spending patterns are changing quite drastically as they're starting to negotiate these higher price environment that we're in at the moment. So next phase here is, you've had the CPI, you've had the inflation reading, you've had the wage data and the jobs data. Now we turn our attention to the retail sales report. And really this is the final, I'd say, piece of the puzzle when you're trying to identify really some of the critical areas of the UK economy. It's then, how are we as consumers faring at the moment? How confident are we with our ability to continue spending in this current situation? Looking at the UK retail sales report as it stands at the moment, we had a 0.6% month-to-month reading, which was actually above expectations last time round. If we look at the daily calendar for today, we're expecting slightly weaker figures, so 0.2, ex-fuel 0.2%, so against 0.6 and 0.9 that we had last time. So certainly it's going to be quite interesting to see the overall kind of health of the economy. We've kind of got all the main data points: inflation, wage growth and retail sales. It should give you a pretty good idea of then where we stand in the state of play for monetary policy in the UK. Okay, quick look at the calendar then. Let's just go back to that for a moment. So UK data, 9:30, that's kind of your next point of interest. You've then got Eurozone inflation figures, but keep in mind these are final readings, so may not have too much of an influence over market prices. You've got the ECB minutes. Now, this is quite an interesting thing, not the minutes itself, but in context of what we've actually seen in the last 24 hours. If you think about it from a fixed income perspective, let me just move back to bunds and T-notes. You can see here pretty decent move here in bunds to the upside yesterday. Likewise in US 10-year. From a central banking point of view, if you think back to Centra, which was the ECB forum in Portugal, I guess this was probably about 6-7 weeks ago now, we had a huge move in the fixed income markets by a concerted effort, almost felt like in a coordinated fashion, that central bankers globally were turning more hawkish. That was several weeks ago. Now what we've had in the last 24 hours is a situation where an ECB source report on Reuters yesterday suggested that Mario Draghi, who is appearing at the Jackson Hole Symposium at the end of August, which is typically a big event for central bankers to unveil their latest kind of policy path. It's a Federal Reserve meeting that happens on an annual basis. Draghi was going to attend. This only further fueled the expectation that the ECB are going to turn more hawkish, because he hasn't attended that meeting for 3 years. It's the first time he's going to be there in 3 years. Why would he speak? Well, the assumption would be he's got something he wants to telegraph to the market in between the central bank scheduled meetings. But the source report yesterday suggested that that's not the case. And actually, he's going to be speaking on a regular kind of overall policy framework speech rather than anything in regards to a policy change. And so that's actually a bit of a dovish statement, and we did certainly see a bit of euro weakness and an equity bid on the back of that yesterday over a brief period. But now layer that in with increased concerns, particularly about the downside risk to inflation with the Fed. Now you've got the Fed sounding a little bit more dovish. So you can see how you've had a bit of a change in tact from the central banks. But what this should do is, if these global central banks are swaying back towards neutral dovish territory, then this obviously will be supportive of fixed income, supportive of equities, supportive of gold possibly as well. And so these are all things to kind of factor in on trying to manage the short-term kind of sentiment. So ECB minutes, I would pay attention to that. They don't normally have much of an impact on the market, but certainly it'd be something where I would be keenly listening just in case. Moving on, as per usual on a Thursday, weekly jobless claims. You've also got Philly Fed coming out in the afternoon at 1:30, and then later industrial output, cap utilization coming out of the States leading index, and the nat gas storage change figure. A couple of speakers, but they're not coming till well after the European close, both of which could be quite interesting actually, because they both are voting members of the FOMC, that being Kaplan and Kashkari. They're both participating in a Q&A, 6 p.m. and 6:45. So any of the guys in the trading live room, if you're still trading, I would certainly be aware of the timings around those particular events. Equity-wise, look out pre-market for Walmart. They can often set the sector sentiment, certainly for the retailers, being one of the largest in the world and certainly in the US. Them coming out pre-market can sometimes have an influence on the futures market ahead of the cash open later. Okay, that's pretty much your briefing. So look out for the data at 9:30, and then US data starts kicking off really at 1:30 and onwards. Fed speakers much later in the evening, and that's your wrap. So any questions, I'll be in the chat room. Otherwise, have a very good day. Thank you very much.